The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets in Europe and North America. Taiwan has climbed past Canada to become the world's sixth largest equity market, while South Korea has moved into 8th place, ahead of the United Kingdom.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about three companies at the heart of the AI hardware supply chain. Taiwan Semiconductor Manufacturing Company, or TSMC, the world's largest contract chip maker, and South Korea's two dominant memory makers, Samsung Electronics and SK Hynix.
It's the AI theme which is driving things. So we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth, which are therefore powering the stocks.
So what does this reshuffle tell us about how AI is changing global stock markets? And what are the risks? To understand why the rankings are moving, it helps to look at what these markets are actually made of. MSCI's indexes are commonly used benchmarks that track large and mid-sized companies in each market. In Taiwan, information technology accounts for about 88% of the MSCI Taiwan index, with TSMC alone making up about 57% of the benchmark. In South Korea, the index is also heavily weighted toward IT at about 61%, with Samsung Electronics and SK Hynix together making up about 54% of the benchmark. By contrast, Canada is still anchored in financials, energy, materials, and industrials, with IT accounting for less than 10%. And in the UK, financials, healthcare, consumer staples, industrials, and energy dominate, while IT accounts for just about 1%. The London market has also struggled to retain and attract high-growth tech listings. ARM, the British chip designer, chose a US-only listing in 2023, a move widely seen as a blow to London's market ambitions.
What we're seeing here, I think, is perhaps you could say the delayed coming of age of the Asian stock markets. And the combination of that and the breadth of the markets and the amount of economic terrain which Asia covers, I think is really what is driving this renewed interest in Asia and their equity markets moving up the capitalization spectrum.
The common driver is AI infrastructure, the data centers, chips, and memory needed to train and run AI systems.
The US hyperscalers, so Meta, Microsoft, Amazon, and Google, are set to spend around $720 billion on CapEx this year, up from around $415 billion last year. And virtually all of that CapEx goes into data centers.
The US still leads in AI chip design through NVIDIA and AMD, but many of the most advanced logic chips are manufactured by TSMC. While high bandwidth memory, or HBM, the memory used in AI accelerators, has become a key strength for SK Hynix and Samsung Electronics, with Micron also competing for share. That demand is already showing up in earnings. TSMC's first quarter 2026 revenue reached $35.9 billion, just above the top of its own guidance range, with a gross margin of 66.2%. Samsung Electronics reported an all-time high quarterly revenue of about $89 billion. Its Device Solutions division, which includes memory, foundry, and system LSI, posted about $54 billion in revenue. SK Hynix also posted record quarterly revenue of about $35 billion, citing strong demand for high-value memory products.
The conditions for these stocks are exceptionally favorable right now. And the key way to understand that is really from a demand-supply perspective. Demand, which already was strong, has recently not just been accelerating, it's taken a quantum step higher because of the transition to the agentic AI economy. The increase for compute, for computational capability is extraordinary. Now, supply for the chips which are powering this just cannot keep up with that demand. And what that's doing is it's giving the manufacturers of memory and other related aspects very significant pricing power.
That memory used to be a very cyclical industry in which essentially pricing of those chips happens on 3 to 6 month terms. So you buy a chip and you pay for it 3 months in advance. Now, HBM, but also conventional memory chips nowadays are being bought and priced in 3 to 5 year cycles. So pricing is set well in advance.
Taiwan is the clearest example of how the AI boom can reshape a national stock market. TSMC manufactures advanced chips for many of the world's largest technology companies and is central to the AI supply chain. It also accounts for more than 40% of Taiwan's total stock market capitalization.
Taiwan's export orders rose almost 66% year-on-year in a month of March, hitting an all-time high as well as the fastest growth in more than 16 years.
But that strength creates a paradox. Taiwan's market is rising because of its exposure to TSMC, but that also makes the market more vulnerable to any shock in semiconductors or geopolitics.
In Taiwan's case, the market is perhaps somewhat more separate from the broader economy, just given the concentration of the market in the heavyweight tech stocks, and may therefore not be as reflective of the dynamics of the onshore economy.
South Korea's rise looks different from Taiwan's. It is not dominated by one company.
If you strip in Korea Samsung and Hynix out of the calculation, the profit growth this year is still going to be 40 to 45%. 40-45% profit growth is still exceptionally strong. And that's because there are other sectors in Korea which are also doing very well away from the chip story. That includes defense, shipbuilding, power equipment generation. You've got the K-culture theme, and you also have the whole theme of bottom-up corporate change through the Value Up program. The market is actually deeper and broader and has more opportunities than just the superstar memory stocks.
But the AI-driven part of South Korea's rally is still heavily concentrated in two companies, Samsung Electronics and SK Hynix. The key product is HBM. As AI models grow larger, memory bandwidth has become one of the biggest constraints in AI computing, and that has made South Korean memory makers critical.
AI models nowadays, they're trillions of parameters in size. A few years ago, there were billions, now there are trillions of parameters for a single model. So this is where HBM comes in. Around the GPU, you have 6 or 8 different stacks of HBM, which is chips that are stacked on top of each other. And whenever the GPU has to do a calculation, it draws upon those HBM stacks to pull in and push out values that it needs for the computation.
South Korea's rise also comes with a caveat. Compared with Taiwan and China, its listed semiconductor sector is more concentrated at the top, with fewer large public companies beyond Samsung Electronics and SK Hynix. AI has supercharged Taiwan and South Korea's stock markets, but it has also made them more dependent on a small number of companies.
If there's any kind of politically driven shortfall in terms of construction of data centers, then that could reverberate up to the hardware companies that are supplying that and are the customers of that CapEx spend by the hyperscalers. Innovation risk, where you've got very rapid changes in the tech space. I know of 6, for example, private companies in the United States which are developing different kinds of chips. If one of them turns out to be something which changes the game in terms of the current configuration of chip supply and manufacturing, that could be something which could be a shock to the incumbent stocks.
A comparable concentration dynamic has appeared in other markets as well.
What happened to Denmark and Saudi Arabia's stock markets last year is a cautionary tale. So both of them were amongst the worst performers towards the end of 2025. And both of them have this one similarity. They are heavily influenced by one corporate giant, respectively. In the case of Denmark, it is Novo Nordisk, as well as its reliance on the obesity drug boom. And in the case for Saudi Arabia, it's the stock market's dependence on Saudi Aramco. And falling oil prices last year really hammered the company, which in turn dragged down the entire index. So the message is quite straightforward. Concentration is all well and good when your star companies are shining the brightest. But when they're not, then the tables tend to turn really quickly.
The big question now is whether this is a temporary semiconductor rally or something more structural. Some analysts believe the rally still has room to run, but that bullish case rests on one big assumption, that AI infrastructure spending keeps translating into profits.
given how rapidly we've raised our earnings forecasts for Korea, we have also correspondingly raised our Kospi targets. First from 64 to 7,000, then to 8,000, and now most recently to 9,000. If the earnings do indeed come through, both for this year, but also continuing into next year, then we think that that Kospi 9,000 target is actually quite conservative. And we could see 10,000 or higher. And I'd say we would map what I just said in a similar vein onto Taiwan. Of course, so much depends in Taiwan's case upon a continuation of the tech hardware story. But since we do think that there's more to go there, then we correspondingly would think that there's also further upside.